Hey everybody, how's it going? Welcome. This is March the 4th, and it's the March 4th Flipping America RIA meeting. I'm so glad you're here. We were shooting the breeze in the chat before we got started here. Reno said that he had picked a tequila and a smoke to pair with this meeting. And I thought that was awesome. That's great. And I'm gonna show you the property pairings video on Elkmont one more time, and then hopefully somebody's going to submit another property, and I'm going to have another video for you next week. So that's coming up in just a few minutes. I am really glad you're here. Let's, you know what? Let's go ahead and get started now. One of the things we're always working on improving. One of my life mottos is I'm trying to get better at this. And we've had some reports that the graphics have been fuzzy. So I did a lot of digging after the meeting yesterday to try to get to the root of the problem. And I'm trying two new solutions tonight. And so your feedback would be appreciated on the graphics, if they're clear or not. I think there was a setting in PowerPoint that was doing it. Don't blame PowerPoint, blame me for not knowing it. But I just went ahead and switched over to Keynote. And we're going to have a little thing from Prezi tonight also. So that's coming up in just a couple minutes. But first of all, let's do this so we can check out the how the graphic looks. Somebody put in the chat, well, you may not be able to tell anything from that, but put in the chat whether that graphic is coming through clearly or not, because I hope it is. Okay. Reno says it looks fine, so we are going on with it. All right. Welcome. This is our new announcement slideshow, and there we go. This is what we're talking about tonight, REI by the numbers. I'm going to go through a bunch of numbers tonight, and it's really just kind of an introduction to the numbers. There are a lot of numbers, and I don't have time to go through all of them, but it's an introduction to a new course that we're going to be releasing by this name. And so I'm going to give the course away to some lucky winner tonight, and Chip is actually sitting in the green room, but you go ahead and start putting your stuff in the chat, and we will review the chat. Lana is here, and we will review the chat tonight. Pick a number between 1 and 100, and the course isn't even released yet, and I really wanted to have a link for you, but I don't have that yet, but I will email it out to everybody that's here. So you could pre-register for the course. This course will be out in the next week or so. It's a remake of some stuff that I've already done, but I'm reshooting the videos. They just looked a little tired. My hair got a little longer, and I wanted to freshen the look a little bit. And also, I've added a few things that were not in the last go-round on this. So REI by the numbers, and the introduction's coming to that in just a minute. Here's the pledge, everybody. Hand over your heart, put your drink down, Reno. Here we go. When I look in the mirror, I see the reason, the credit for my successes, the blame for my failures. I cannot make it without my team, and I tell them often. But when they succeed, it's because I chose well and I led well. When they fail, it's because I did not choose or lead well. I am the reason. I may have setbacks, but I cannot fail if I don't ever give up. You got circumstances, I got circumstances, we all got circumstances, but you won't find me under mine. I know that's not the best grammar there, that's intentional. My situation will not dictate my emotion. My circumstances will not control my results. External forces will not take away my power to choose. I cannot change the world, but I can change me and the way I relate to it. So I charge on. I am the reason. I have a massive vision, which creates massive pressure, leading to massive action, which is the only chance I have to achieve massive results. The world doesn't owe me success. God doesn't owe me success. No one but me is going to work for my success. Therefore, no one will work harder for their success than I will work for mine. I will give my all and then a bit more, so tomorrow my all will be more. Okay, thank you. You may be seated. Tonight we're going to be talking about the numbers. Next Wednesday we're going to be joined by the top dogs over at Bay Mountain Capital, Will and Wayne. Will Dyer and Wayne Corley will join us, and we're going to talk about getting hard money. The hard money loans are out there. They're available. It's not hard to get. It's called hard money for a different reason. We'll explore all of that and some of the things that I particularly like about the approach that Bay Mountain Capital brings. I'm thrilled to recommend them to you. I wish they were loaning in more states so more of you would have access, but Even if you're in a state where Bay Mountain isn't yet, we'll find someone. We'll try to match you up with someone and connect you. That's what we're here for, is to connect you with the resources you need. Next Thursday night, I've got Paul Williams joining us. I met Paul just about 2 months ago, and he is a really interesting guy, nice guy, built up a big business, sold it, then got into real estate, dove right into multifamily, and we're just going to visit for a little while. I want you to meet Paul. You'll be inspired by him, you'll be informed by him, and also a little bit entertained as the evening goes along. And that's next Thursday evening. I haven't shown this slide lately, but since I just remade this entire slideshow, you're getting them all tonight. If you have an you-know-who enabled device, in case any of you have one of those devices in the room right now, you can just say, Alexa, play the podcast Flipping America, and the magic will happen. The last episode that we've released will start to play. It's pretty cool. I didn't even do anything to set that up. It was just great. All right. Here's some resources for you. This is a time for you to take a screenshot because I'm not going to go over all of these, but we've got a ton of resources that we're putting together, and we keep on adding to this. The gentleman that we had on yesterday has a complete lineup of courses on financial education, and he has graciously allowed us to start listing those in the Flipping America Academy. We've got to work out some details on that, but you'll be seeing resources, that as part of the resources as well. Deals from the MLS, self-directed IRA, analyze your deals, a way to get insurance for your deals. All of this is here. Just take the screenshots as these roll by. And of course, this is Flipping America. Flipping America is the brand. It started out as a show, which is coast-to-coast broadcast 3 times a week. And also we turned that into a podcast. And it's a free app. I think the best way to listen to the show is to download the free app. Please download the app. The advantage you get to the app is that's the only way to get access to my inside show notes. You get behind the scenes look at what we're looking at, and the links are clickable on your phone. So download the app, listen to the show. You could search by topic, or you could search by person or anything. If you want to say, when did he do that certain poem on such and such and such, you can search for it, and maybe you'll find it. Then we formed the Flipping America Real Estate Investors Association. The idea was local networking with a national impact. We didn't plan on the pandemic, of course, but the dream is when the pandemic is lifted, we will have local groups meeting in their chapters around the country, joining these Zoom calls on Wednesdays during the lunch hour and Thursdays at 7:30. And I had no idea, once the pandemic hit especially, I had no idea how it would happen, but it is happening. We are now 30 chapters across the country, and we just went over 10,120 members in our meetup groups, and that's pretty exciting. That's a long way to go in just a year's time, and I'm thrilled. It's an honor for me, really. Then we are just now launching the Flipping America Academy. It doesn't even have a web page yet, but there will be a landing page that has all of these sources, and you can see the REI by the Numbers course that is coming. We also have another course that is coming out soon called Say What. It's the terms of real estate, how to know what's what, and so you can speak the language of an informed real estate educator. The Raising Private Money course is there. That is a free course, and if you take the free course, I will pay for your $49 admission to Dave Dubo's day-long workshop. And then we've got Find Your Fit in Real Estate Investing, which is another free introductory course. And then the Real Estate Investing Quick Start. That's what's there now. There's more on the way. The Flipping America Buyers Club is a done-for-you buying service. It's really a way to invest in cash flow. Don't even think of it as investing in properties. We got to think about the properties a little bit, but only to the extent that someone else may want that property as is. We're not rehabbing these properties around the country. We're just selling them as is. And if you pay attention to the show, to the little thing with the music and everything playing, there is a camera on the license tag wall over there, and the license tags are the states where we've bought properties for this club. But there's the link to the club. And then this is what's coming end of March now, looks like the date. We've been through our user testing, our focus groups. We've got some things to fix, which is good. We got some great feedback from the group. And but we're working hard behind the scenes on this. Early morning meetings, late night testing, and so forth, right up until time to release. The Flipping America Network is going to be one more fantastic thing. We're going to do a whole evening on it whenever it's really ready to go. So I'll save my ammunition on that one. Want to encourage you all to say hello to each other in the chat, and say hello to me. I'll try to talk back to you. I'm not going to be interacting much in the chat right now, but if you're watching on Facebook and YouTube right now, then please do say hello, put in the comments there. I'll see them on this screen. If you have a question for me as we go along, use the Q&A tab. Those of you that are watching on Facebook and YouTube, use the comments there. I'll see those questions and I'll try to deal with them, but use the Q&A tab. If you're on the call here, I will see those. I haven't opened up the Q&A tab, but I will in just a few minutes. Actually, I'm not going to open up now. It'll just be one more thing to distract me, but I will stay here and answer your questions, okay? Want to encourage you to join the Flipping America RIA. Hey, for all that you're getting, these 2 meetings every week, the content alone ought to be worth you buying me lunch once a month, right? That's what $10 would do. In most places, that's what lunch costs these days. For $10 a month, you can support what's going on and make sure that it continues to go on. And then there are other benefits too. Just go to that link, bit.ly/FARRIA join, and you can get the full scoop on it. Okay? All right. I think, yep, that's it. We're gonna do the numbers in just a minute, but first, stay tuned for this right here.
When you choose American IRA as your self-directed IRA administrator versus the other guys, you're choosing a path that will save you money without sacrificing expertise.
Hey, can everybody hear the video? Because it's not playing right here. Somebody say something to me. Put it in the chat. No. All right. Let me see. Give me just a minute.
Choose American IRA as your self-directed IRA administrator versus the other
now?
guys,
Can you hear it
you're
now?
choosing a path that will save you money without sacrificing expertise or performance.
that's good. I'm glad
Because
you can hear,
unlike
because I
the
can't
other
hear it
guys,
here.
we do not work on a sliding scale of fees. We offer one low set annual administration fee. Let's take a closer look. As your assets grow with American IRA, your annual fee remains the same. The other guys base their fees on the number of assets you own or the value of your account. So over the life of your self-directed IRA, your annual fees will continue to increase year after year. What does this mean for you? When you work with us, you'll have more money to put towards the important things in your life, like retirement. We know that there are already enough places your money has to go, from your state and local government to the IRS. Don't let your self-directed IRA administrator take more from you than they should. So with American IRA, no matter how your assets grow over the life of your investment, you'll pay one low set annual fee, putting you in total control of your financial future. Choosing American IRA means you're choosing expertise, value, and performance.
All right, we are back.
Wow. That's going to be a tough
Chip
act to
here.
follow.
Now I don't hear Chip. Okay, hold on a minute. To me.
Hey,
Okay, I can hear you now. Can you all hear both of us out there? I don't know what's going on with the sound here. Okay, you all can hear both of us. Okay,
I'm
that's
here.
great. All right, Chip.
okay, good.
Good to see you,
Hey,
man.
that's
How's it
going to be
going?
a tough act to follow. I like that American IRA video. That's going to be tough for me to be better than.
It's not a competition, man. It's all right. You're
That's right.
completely different. You're not offering the same service anyway.
Yeah.
You've got something that everybody needs just as much as they need American IRA. That is money for deals.
Right. So in a little bit when I'm on the Zoom call, I'll put in the chat what our rates and terms are. But Bay Mountain Capital is a hard money lender, and we do fix and flip loans, rental loans. Right now, we only have a 3 or a 5 year rental loan, but there's some reasons why those are good. And that would be that you can do Airbnb with them, any short-term rentals, because we don't require a lease, nor do we have a prepayment penalty. Then we also have new construction loans. And so the fix and flip and the new construction loan can be up to 100%. And so it's a really good terms right now. I'll put those in the chat, like I said. So I wanted to tell you all about a little success story. Got a family down in Savannah that has been having some really good success. And if you were on the call yesterday, you heard me talk about it. I do have a little update since yesterday. So the Suttons have been just investing since June of last year. They closed on their first deal on June 12th, and they paid it off on September 11th. So they had it just under 3 months, and they made more than $50,000 in profit on their first deal.
Man.
Now they at the time, we weren't even working with new investors, and they came to us and had a lot of training with fortune builders. So because they had a lot of knowledge of the business, we decided to let them go ahead. They did have to put 20% down. Right now we're working with new investors and they put 15% down. Anyway, they finished that one, got a second one, and that one also took less than 3 months. Then in the fall, they closed on the third and fourth one. And the third of those has already paid off. The fourth one is going to be listed by the end of this week. And what they think they're going to make off of that one, plus what they've made on the other three, they've made over $200,000 in profits. So that's over $50,000 per house. They're doing really, really well. Now, these last two houses took slightly over 3 months. And at the same time, while they were working on those two houses, Jonathan was working in the Savannah shipyard, and he put in 700 hours unloading the ships. And I guess that's why it took him longer than 3 months, right? Anyway, apparently that gets you the official seniority card, and he'll have that for life of the International Longshoremen's Association.
Yeah, I'm not really sure what that's going to do for him in his real estate career, but that's a good thing, I guess.
It doesn't affect his real estate career, but I'm just saying he was able to do those two flips while he was doing that. So this is something you can do part-time.
Right. It is.
All right.
Yes. You can do, you can flip houses in your part-time, and it's easy to make six-figure income a year if that's all you want to do. Yeah, in your part-time.
And there are still investments out there. I hear people all the time saying, I can't find a house, but they're out there. They've found 4 of them in a little over 6 months. Well, let's see, that's about 8 months, but there are, I'm closing loans every day, every week. So people are finding deals.
Well, and all the markets are different. You know, Savannah's probably a little easier to find a deal than Atlanta, but even in Atlanta, people are finding deals.
Absolutely.
Yeah. All right. Well, thanks, Chip. And Chip's going to leave us now, and he's going to join the Zoom call. So be sure you put your number from 1 to 100 so you can win this course that I'm giving away tonight. And anyway, we'll announce the winner at the end of this thing. Chip, thanks.
All right. Thank you.
All right. We'll see you.
Bye, everybody.
All right. Let's do this. Hey everybody, how's it going? I'm coming to you live from my balcony right here in Midtown Atlanta. And the reason I'm outdoors is going to become apparent to you in just a few minutes. But today I want to talk about a property that we just rehabbed in Elkmont, Alabama. Now, I don't normally go that far out of the city, but this was a unique opportunity. This is a 100-year-old farmhouse that it was in need of some love. We picked it up from the HUD Home Store, and we're in the property for about $125,000, $130,000. I don't know the exact dollar yet. We've got a few more things to do. But now I'm going to throw up on the screen a little bit about what it looked like. Here's some before pictures, and there's what it looked like on the outside before. And the after picture of the outside is not that much difference, but you do notice some improvements there. We fix everything that's broken and make sure that everything is right. But the real beauty of this house is on the inside. All new floors, all new paint, and an all new kitchen. Here's the kitchen before, and here's the kitchen after. Beautiful job. Got the property on the market, got a full price offer. My investors are thrilled with this progress. We actually got a little bit more for it than we thought we were going to get when we bought it. And so that's always good. And so I'm thinking about this 100-year-old farmhouse, and I think it over and you know what would go great with a 100-year-old farmhouse? I had an idea, and here's the idea. We're going to go over here and we're going to go down here and look inside my humidor. Inside my humidor, there is a cigar that will go perfectly with this property. Oh, here it is. It's a Rocky Patel Decade. Yes. Old farmhouse, a cigar with a history. Why not? Right? All right. Now, I'm just going to, I can't wait to do this. I like these anyway. I've had them for a while. So cut it. And I'm thinking, what goes with a 100-year-old farmhouse and a decades-old cigar? How about this? A bottle of Bellemeade Reserve Bourbon. This is some good stuff. You can see, I've tried it. So there's a story with this bourbon. This bourbon was produced by Charles Nelson in conjunction with the Sperry Wade & Company in Greenbrier, Tennessee. Now, they were great. This bourbon was a bestseller, and it launched in 1878, but it was, of course, went out of business during Prohibition. Fast forward this story to 2006. Andy and Charlie Nelson, two young men, just graduated from college. They were running an errand with their father, and they saw, they were outside their home in Greenbrier, Tennessee, and they saw a historical marker about this distillery run by Charles Nelson. Well, that's part of their family's past. And one of the boys said this was one of the most clarifying moments in his life when they realized they had stumbled across the distillery that their ancestor had run, and they did some poking around and they found the actual buildings. Long story short, they reopened the distillery and are producing this historic bourbon. So while I get this cigar lit, I'm going to tell you that, yeah, there you go. And this is why I am outside. We're going to tell you that I like the idea of pairing a property with a cigar. It's kind of just an excuse to smoke a cigar and have a sip of an adult beverage. But I'll let you know in just a minute what the tasting notes are on this cigar and this whiskey, because, you know, I'm such an expert in all things, right? Okay, let's see here. You know, I just love it when they say that, you know, they can taste notes of licorice and chocolate and so forth. You know what I taste in this cigar? Pretty good. That's what I taste. Well, what it kind of tastes like is it kind of tastes like a 100-year-old farmhouse that's been renovated and rehabbed. And here's a little bit of that Bellemeade bourbon. Let's see how this goes. First, you have to nose it, right? And, you know, you read reviews on this and people say, it just reminds me of apple pie. Somebody else says cinnamon and vanilla spice. Oh, it's got oaky overtones. You know what I say? 100-year-old farmhouse in Oakmont, Alabama. Yeah, I'm just as right as they are. You have a property you want to submit to me for a property pairing? Send it in to propertypairings@flippingamerica.net. I'll get it right. I'll come up with a perfect pairing for a whiskey and a cigar. How do you know I'll get it right? Hey, I'm the Flipping America guy. You can't argue with that. See you soon. All right, and we are back, and we're ready to dive into the topic for tonight. And what I told you we were going to talk about tonight is the numbers, and I am ready to talk to you about the numbers. I'm going to give you a quick overview now of really all of the important numbers that you need for buying and flipping, or for buying and holding. You ready? All right, don't hold your breath through this because it's going to take a minute. Here we go. Here's some stuff that you need to know. And notice I've got 1 through 8 here. These are 8 data points that you need to consider. Now, this is about flipping right now, all right? So get ready to take screenshots or whatever you want to do. This was kind of obvious maybe, but I'm assuming that there may be someone on here that has no experience. Maybe you're brand new. So there is a thing called the ARV. I don't ever say ARV. Please don't say that in front of me because that just sounds goofy to me. It's ARV. It's not that much longer to say ARV. It stands for after repair value. Now your realtor, unless they are used to working with investors, a realtor is not automatically going to know what this is. The ARV is the after repair value. What it really means is what this property is worth when it's all fixed up. This is kind of the jargon that we use in the industry, and you need to know this no matter what. It's important whether you're going to hold it. It's important if you're going to flip it. It's especially important if you're going to flip it. And how do you learn what the ARV is? You must run comps. How do you run comps? What is a comp? It's a comparable sale. It's not a comparable listing necessarily. It's a comparable sale. This is where you look for properties that are similar in size, age, and condition, and in the general location, that have sold in the last 6 months preferably, but if you don't have enough, maybe you can go back 12 months. But you're looking for comparable properties, what they sold for. This is going to give you an idea of what you can sell your property for. You can't just make up a number here, and wishful thinking is not going to increase the price. Hopeful optimism is not going to make a difference. It is what the data says it is. You have to know this number, and it's best to be conservative. In all of your numbers and your estimations, it's always best to be conservative. That gives you a little room for things to go wrong. And so if you want to be conservative with your ARV, guess on the low side. If somebody tells me this property will sell for anywhere between 150 and 165, I'm writing down 150. That's my number, and that's what I'm going to go with. Next, you want to think about what it's going to cost to repair the property. Now, we just got off a coaching call a little while ago, and we were talking about the importance of speed. And because of the importance of speed, a few years ago, I looked for a way to speed up my ability to make an offer. I wanted to make offers from the desktop, blind. And I wondered if there was a commonality to the rehabs that we did that would allow me to estimate a rehab based on certain factors in the house. It took me a bit of time and a bit of research, but here's what I came up with. A default repair formula. I've used it now for years, and I'm going to share it with you. I don't have it on the screen here, but get ready to write it down because here it comes. We assume that when we're rehabbing a house, we're going to rehab about 25% of the property. So therefore, if the house costs $100 a square foot for the cost of construction, we're going to spend about $25 a square foot, because really all we're really remodeling is usually the kitchen, maybe the master bedroom, and the bathrooms. We're updating all of those things and making them really shine and seeing. There's not a whole lot you can do in secondary bedrooms. So that's about 25% of the property, so about $25 a square foot. And that's where we start, $25 a square foot. Plus, things in houses wear out. They don't wear out uniformly. Well, it's kind of a steady erosion of things, but you don't have to spend big money except about every 10 years or so. So what we have done is every 10 years of age in the house, we add another $5,000 to the repair budget. So it's $25 a square foot plus $5,000 for every 10 years of age. Plus, sometimes you want to add another bathroom on and you have to add square footage. That's going to cost you $100 a square foot. So add that in. And then occasionally you're going to have something that is just so different or weird, you really don't know the cost. So a tree broke over and a branch fell and there's a hole in the garage roof. You don't know what that's going to cost to fix. You're not going to run into that all the time. You've got to just get that number, get a quote from somebody on what it's going to take to fix that, and do the right thing for the rest of the roof while you're at it. So when you put that, I call that the weird stuff. When you put it all together, it looks like this: $25 a square foot plus $5,000 for every 10 years of age, plus $100 a square foot for additions, plus the weird stuff. That's your default repair formula. It is not guaranteed to be 100% accurate, but usually when it misses on the high side, which if you want to be conservative in your numbers here, that's where you want to be. You want to overestimate the cost of your repairs. Then you have the rehab burn rate. I don't see a lot of people talking about this, but this became a useful number for us in our business. And it turns out that a good contractor who is staying on the job and staying after it day after day can go through about $1,500 a day. Well, that works out to about $7,500 a week, but really it's about $10,000 a week that we can spend, but I don't expect the contractors to work 7 days a week. If they want to work 6, that's fine with me. I'm all in favor of 1 day of rest every week, and so I don't give them a hard time if they have a particular day, either for personal reasons or for religious reasons. It's all right with me. But I expect that we'll spend between $7,500 and $10,000 a week, and I kind of boil that down into $1,500 a day, and you'll see why this is important in just a couple minutes. The average days on market. This is some information that your realtor can provide for you. What is it going to take to get from the day you list it to the day that you get that contract? And then you can add 30 to 40 days after that to get to the closing table. So your average days on market is something that you need to be aware of. And just a little hint, if the average days on market in this market is over 45 right now in this economy, don't buy it, because there's something wrong in that area. But I don't think that's truth. I don't think that's an accurate number anywhere in America right now. So average days to permit. This is an important number to know if you're doing a big rehab that requires a permit. How long is it going to take you to get that permit? In some smaller cities where we've done work, it was a breeze, just in and out in 1 day. In other cities, it's 6 weeks unless you hire an expediter, and then you might be able to get it in 2 weeks or 1 week. But it just varies. You need to know how many days it's going to take you to get the permit. The reason is it's going to affect your costs, especially if you have a loan on the property and you're paying interest. There's a daily cost to that interest, and every day is money. Okay? Now, another data point, the long-range weather forecast. This is not a number that you can really put into a formula, but it's important to know if you're looking at a property that you have to paint the exterior and you're in for a month of freezing weather, you're not going to get painted. So you're not going to get the project finished. That's something to keep in mind. And that's something to consider before you dive into, especially if you live in the northern climate. We're sitting on a house in Miller, South Dakota right now. We're just waiting for it to get warm enough for us to paint. We're almost there, but not quite. But we've had it for a minute. And that's just the way it is. Okay, loan terms. What is your interest rate? And that's going to affect, of course, your monthly payment. But we boil that down into a daily amount, and I'll explain why in just a few minutes. The seller's loan amount. Why is this an important number? It could be that you want to make a creative deal proposal. So if you're talking directly to the seller, now this is not going to apply if you're buying through the MLS or going through an agent to make an offer, but if you're talking directly to a seller and you have the possibility of working out some sort of flexible arrangement on the deal, you need to know the amount of their loan, and you need to also know their remaining principal balance. So how do you do that? Well, here's how we use the data. First of all, this is the formula for remaining principal balance. Oops, let me back up a little bit there. I didn't spend enough time on that. Okay, there you go. Take your screenshot. Enjoy that. That is a lot of fun. Trying to use that to figure out. So what this thing does, if you know how to fill in the variables, you can take what they originally borrowed with their interest rate and their loan term, usually 30 years, and you can back into what they still owe on the property. They may or may not know what their payoff is, but you can have that figured out before you ever have the second conversation with them. And so you can know what your possibilities are in terms of a creative deal. But I'm pretty sure you're not going to figure it out manually from this. I can recommend the Power One FE calculator that you can get for your phone. I can also confidently recommend a program I'm going to show you in a few minutes called FlipCalcs. It's in a spreadsheet form right now, but it is being developed as we speak into an app that will work on your iPad for sure, and maybe on your phone as well. But I'll show you in just a few minutes. Here's your offer formula. You've probably heard this offer formula before. It's the maximum allowable offer, MAO, M-A-O, equals ARV times 0.7. Do that first, and then subtract out your repairs. That's really what you should give. Now, if you're kind of a savvy math nerd, you're probably thinking, well, that's a 30% margin. That's pretty healthy. You're right, it is. But this formula doesn't take into consideration your cost of overhead and commissions and other costs related to the closing. So if you follow this formula and everything goes perfectly well, you will end up with maybe a 20% net margin. And if you know anything about business, you know, well, 20% net margin that's really strong. That's good. Yes, it is. The thing about it is, there are a lot of things in this business that can go wrong, that can mess that up. We're talking about houses that have been used or misused or abused, and there may be repairs that you didn't anticipate, and you're going to encounter surprises, and you may need to end up spending more money. We always should have a contingency in our budget, but those extra expenses are going to eat into this bottom line. And sometimes the market changes. You might end up selling it for less. You might end up having to spend more money in your repairs requested by the buyer when you're in the inspection process and you're under contract. You never can tell. It's going to end up probably costing you more than you thought. That's why I have a little Rogerism. Everything costs more than it costs, and everything takes longer than it takes. That's just the way things are. And I build some of that into these, into the math here. So even if things don't go exactly right, or even if they go sometimes horribly wrong, we can still make a little money, or at least break even. The goal here is to not lose money, right? All right. Now, this is a complicated looking screen, and we're going to zero in on all this. And I've got some formulas here that I've never seen anybody else teach. But the nerd in me wanted to break this thing down to the best set of numbers that I could get. And here's how it worked out. First of all, rehab time. I have a formula that's going to tell you how long it will take you to rehab the property. How did I get it? Well, remember the burn rate of $1,500 a day? So your rehab time equals your rehab budget divided by 1,500. That's more or less going to tell you how long it will take. So if you have a $15,000 rehab, then they should be able to get it done in 10 days. See? Divide it out that way, and there's your rehab time. And we're going to stay with days here because all of this is kind of in days because we want to get down to a daily cost. Here is a formula for your hold time. I bet you didn't know there was a formula for this. Well, I invented it, so unless you've known me for a while, you may not have known that there is a formula, but this formula will tell you exactly how long you should expect to hold a flip property if it goes right. Why do you need to know how long you're going to hold it? Can't you just assume it's going to be like 6 months? Well, I don't know. If you want to be precise, if you want to make plans, and if you also want to have something to hold everyone on your team accountable, because this kind of becomes your target, and you're going to push to try to make this happen. Your hold time is your permitting time, that's the PT, plus your rehabbing time, plus 21. What's the 21? That's 21 extra days for bad weather and sorry excuses, okay? Plus the days on market. That's how long it's going to take you to get the property sold. So you add all of those together, and if they are less than 120, then it's 120. If they are greater than 120, then it's whatever the number is. Why the 120? The reason is, in most cases, you're going to have a buyer who's going to borrow money, and they're going to borrow money with a conforming loan, whether it's FHA or not. It probably is conforming to FHA underwriting standards. And therefore, the 90-day flip rule is going to come into play. The 90-day flip rule says that you cannot sell this property for a profit within the first 90 days of ownership. On day 91, you can sell it for whatever you want. I don't know that values and properties really change that much between day 90 and day 91. I understand the purpose is to stop the crazy things that we were seeing leading up to the crash of the 2007 and 8 period, where people would buy a property one day and sell it the next day for a little bit more, and then they'd sell it a couple weeks for double the money, and that sort of thing was going on. And there were some of that going on. Some of it was legit, and a lot of it was not. So they instituted the 90-day flip rule just to make sure that you're holding on to the property. That gives you time to do something to add value to the property. All right. And that's what we're doing with our rehab. first of all, we're hopefully buying them at below market prices, and then we're adding value and then selling for market prices. And that's how we get those kinds of margins. All right. So you can't really write a contract until day 91. There are some workarounds that we talk about in our training, but I'm not going to get into it now because we've got a long way to go here. Daily costs. This is another formula you're not going to see taught out there. This is another opportunity for you to take a screenshot because you're not going to see it anywhere else. The daily cost is your interest divided by 365 plus your insurance costs, your annual insurance costs divided by 365 plus your taxes divided by 365 plus your monthly utilities and maintenance. That's MUM. This is not a British thing. Monthly utilities and maintenance times 12 divided by 365. When you add all of those together, you know what it costs you every day to own the house. Why do you want to know this? Is that just a nerd thing that you just feel happy that you know what it costs? No, here's why you want to know. You've had this house now for 4.5 months and you get a low offer and it's a lot lower than you wanted to take for this house. And so you plug the numbers into the little calculator and FlipCalcs and you're kind of disappointed with the result. And you're thinking about what to do. And one of the things is, no, I'm just going to keep it on the market. But then you can ask yourself this question. Based on the kind of activity I've had, how long would it take for me to get another offer on the property? Now, I know this is not the reality that we're living in right now with, multiple offers in one day and all that stuff. But look, times are always changing. We are going to get back to normal one of these days. And you're going to have decisions to make. And it's not just the scenario I just painted for you. I had one of my coaching clients was out there with a property and they wanted him to make a bunch of repairs on the property that were going to cost several $1,000s. This is during the inspection related repair request time. And when we talked about it, he wanted to kill the deal and just wait for the next buyer. I said, all right, if you were to do that, let's say, because the market is hot, let's say that you'll have another offer on the property in 3 days. He said, yep. I said, all right, and then we've got to go from there to probably 40 days for closing. He said, yep. I said, what's your daily cost? He said, oh, that's going to cost me like $4,000 to hold it another 40 days. I said, versus spending the $2,500 here to make these repairs that you didn't want to make. Oh, so he made the repairs, we closed, boom, done. If you know what your daily costs are, first of all, you're just being a good steward of the opportunities that God has given you. But secondly, you are able to make better, more informed decisions when presented with situations like the one I just described. Okay? Sometimes you will opt to go ahead and spend a little more now or take a little less now because of the cost of holding it. Now, I will say this. Most of your daily cost is in interest. That's why you want to know your interest on the loan. And the lower the interest rate, of course, the lower your payment and the lower your daily cost. So pay attention to all of this stuff as you go by. All right. Next, ROI. You've heard talk about the ROI, the return on investment. We could get a lot more into this, but we're not going to do it in this talk. This stands for return on investment, and there's a simple formula for it. Now, I think a return on investment is a meaningless percentage unless you annualize it, because when you annualize it, then you have the ability to compare that with other deals that may take different amounts of time, and you can also compare it with other things that you can do with your money that bring in an annual rate. So you will always see me annualizing these returns. So ROI is profit divided by the investment, okay? That's going to yield a percentage. Then multiply that times 365 divided by your hold time. So if your hold time is 180 days, just say 6 months, okay? And remember, we had a formula for hold time, right? You see how this is all connecting? Okay, so you can do a little bit of a pro forma on what your ROI is going to be if you have something, some brilliant spreadsheet somewhere that connects all of this, okay? So 365 divided by 180 is roughly 2. So let's say your profit was $30,000 on a $100,000 investment. You hit that 30% margin, and that's a good deal. So that's 30%. But you multiply that times 365 divided by 180, and now you're at 60%. And so your return on investment annualized is 60%. That's how this works. Now, I encourage you to do this also to calculate your return on cash. This is a little bit different than the return on equity calculation that's used in rental properties, and I definitely don't want to get into all the details on that. But really, we're just thinking about the amount of cash that we use, just very simply. If you say, for example, you go to Bay Mountain and you take out a loan, and let's say you took out a loan on that property that we just talked about, $30,000. I don't know. I should probably have Chip on here. $100,000 loan. You're not going to spend a whole lot there. A couple thousand in points and 6 months. $6,000 in interest, and so. Let's say you get 100% financing on it. So let's say you're out of pocket $10,000 on this deal. And because it was a good deal, obviously, because you end up with a 30% net margin. So you're out $10,000. So now you take that $30,000 profit. Well, it's reduced by $10,000 because that comes right out of the profit, right? So you made $20,000. $20,000 divided by the cash used, which is what? $10,000, and that equals 2, or 200%, times 2 is 400%. 400% return on cash. Okay, my friends, that doesn't even seem real, but that is actually a fairly normal number when you're doing flips well. Your return on cash is staggering. And that's really the only reason I agree to let flipping houses be called investing, because you're not really investing in the sense that your money is working for you. You're out there, you're running a business, and it's a lucrative business, and you're doing well. It's not investing in the classic sense. But in this sense, when you think about the return on your cash, it's staggering. I've had several deals where my annualized return on cash was over 900%. Now, granted, I was buying houses back when, the price of houses was very low because of the crash, but it's fairly routine to make 50 or 80% annualized return on cash when you get to the end of a deal and you look at it. And if you know these formulas and you can run them and look at the possibilities, it helps you to make a decision about doing this deal versus that deal. And also, it gives you a way of keeping track of your relative success. Now, we're not going to take a long look at flip calcs, but I am going to show you a little bit about it, and I'm just going to pop it up here on the screen. This actually is a spreadsheet that I developed for use in my own company. And when we started thinking about turning it into a commercial product, we made it prettier, okay? But it's a series of calculators. You remember me telling you the rehab? Oh, let's go to the Quick Mayo. This is very simple. Quick Mayo formula. You just come in here. You don't ever type anything in the purple. You only type things in the green. And so let's say that your ARV is 250,000, and your repairs are 42,000. Boom. There's your maximum allowable offer. Just calculates it for you that fast. Okay, clear this page. Let's go back to the main menu. Let's look at the quick rehab estimator. Remember I told you what it was? The first thing you have to do here is you put in your rehab multiplier, and I said in most cases that's 25. So we put in 25, and then the square footage of this house, let's say it's a 2,400 square foot house. What am I doing? I'm pausing. I guess we have lag. Oh, there. Well, I got an extra 0 because I didn't see it on screen there. The year built. Let's say the house was built in 1990. And we're not putting any additional square feet. There's no weird stuff. There's your rehab budget, $75,500. Now, what I would like, if there's anybody on the call that's done a house like this, actually, somebody in the chat right now, just put in, I see Julie saying the screen is blurry. Okay, I'll keep that in mind. Nothing I can do about it right now. But give me some numbers on a deal you're looking at right now in the chat in terms of the square footage of the house and the age of the house. And I'm going to start with 25. All right, Nina, what's 295? All right, 2143 square feet. Square feet. All right, and the house was built in 1982. You adding any square footage? No? Oh, 1984, she said. I don't think that's going to change the number here. 1984. So, do you have a $93,000 budget? Who knows? But that's a good place to start. And when you get out there and look at the property, you can, affirm this or you can correct it. But I would use this number all day long to make an offer. And there's a button here called click here to use this number in the quick Mayo. So you click that and look, it's already over here in your Mayo. So Nina, what's your ARV on that property? $370,000. All right. All right. So I'll put $370,000 in there, and there's your Mayo. Your maximum allowable offer is $165,495. Isn't that pretty clever? I like it. All right. I'm fairly proud of it. Let's go back to the main menu. There are a lot of different calculators built into this thing. The remaining principal balance is one of my favorite ones. Let's say that somebody here, you're talking to somebody on the phone, and they took a loan amount. They borrowed $245,000, and they did this in 2003. And they had the going rate at the time, which was 7.5%. And they did a 30-year loan. And that house is now worth, we've gone through a lot, but it's up to $360,000. I'm just making this up. This calculator instantly tells you now that what their principal and interest payment is, the estimated loan balance, if they haven't done any modifications in that time, the net equity in the house, and what their loan constant is. I'm going to get into loan constant in a few minutes. And so you can see there's useful information here, and it's right at your fingertips. It's just like that. This is going to be a killer app. And I never say anything about it because we're not in the very beginning stages of development. The spreadsheet works just fine, but we are only, like a third of the way through the development process. So clear that page, go back to the main menu. I'll show you one more thing on here. The linked offer calculator is this button here. And this is what you just bring this up when you're on the phone with somebody. You start asking them all of this information about the property, and it starts filling in for you all of this stuff and starts suggesting things that you can do. Then you go to page 2. There's a little bit more information to fill in. You see the orange stuff over there? That is what it's telling you. You need how much cash you're going to need and how much money you would make, and all of your different deal outcomes. Rental with new loan deal summary, a loan flip deal summary, buy with cash, buy with equity partner. And then you can go to the there's a linked seller financing calculator in case you want to propose to the seller that they do seller financing on a component of this. You can put in rate and term and experiment around with different things. And when you get all this done, you can come over here and you can look at your outcomes in this handy little chart. And you have all these different acquisition types and the amount of cash you need, your profit, your return on cash and return on investment annualized. Plus, if you're going to hold the property, you get a bump in your net worth based on the equity in the property. It tells you all of this just by filling out this. Now, the other thing too, and I'm not sure whether this is really going to work, but if you click on these badges throughout this thing, it takes you to a training video. Look at that. Press play. Welcome to FlipCalc's offers. And I know that you can't hear that, so that's all I'm going to do with that. All right, so that's kind of a look at FlipCalcs. And, all right, I'm back here on the internet. Not that one. How about that one? Not that one. Where are we? I lost my place, everybody. Actually, I should not have hit that video button. Hold just a moment. Okay, I'm back. No, there we go. Whew. Okay, sorry about that. All right, now let's talk a little bit about buy and hold numbers. We're almost done here. We're going to talk about what to offer, the data points, and how to put it all together. And I'm not going to have time really to go into as much detail as you would probably need, but just to let you know that this is what's involved in knowing the numbers on a buy and hold deal. Because look, I'd love for you to flip houses, but I don't want you to flip houses forever. I want you to have properties that will provide income for you for the rest of your days. All right. And if you tune into these things, you know that's what I'm about. Financial freedom. And it doesn't take a lot if you have a reasonably modest lifestyle. It doesn't take a lot for you to get to financial freedom. If you have 10 paid for rental properties, most people can live a good life on the income from those. And my purpose is to help you get to that point where you have 10 or 15 paid for rental properties. You've got cash coming in from bore houses. You know how to make income on a flip. You could do this from this as a side gig if you wanted to and build your own little miniature real estate empire. Any of you can do it. And I'm trying to put together the tools to help you get there. That's what this is all about. All right, so here are your formulas for buying rental properties. If you can buy a house for the rent times 60, you're in great shape. Let's say the rent's $1,000. Then that would mean you're offering $60,000. Good luck finding one for that, but if you ever do get one for that, take it, even if it needs work. Well, with some caveats there. There are other things to consider with buy and hold properties besides the numbers. The numbers is a place to begin. The numbers are a place to begin. But you also need to consider other factors that we'll get into in the buy and hold course, but in our rent starter course, we get into that. But definitely, where the house is. Just think about that for a minute, because the numbers aren't going to help you much if it's in a location where people just don't want to live, right? And then there's the 1% rule. This is a fairly well-known or famous rule for buying rental houses. It says that you want to get 1% of your costs in it in rent every month. So if the rent's $1,000 a month, you want to be in the property for no more than $100,000. That's a pretty good rule of thumb too. Without going into all of the math, if you have a rent times 60 deal, your net return on cash, barring any horrible things, will be around 15%. And if you get a 1%er, your net return on cash will be around 9%. And I could show you the math, but we're almost out of time, so I'm not going to show you the math tonight. I'll do it for you some other time later on by request. All right, when it comes to knowing interest rates, you need to know your seller's interest rate, and I showed you the reasons why. And you need to know your interest rate, because connected to both of these interest rates is a loan constant. And the loan constant is going to be an important component in knowing whether or not this property is really going to cash flow. You need to know the market value of the property, because that's going to determine how much you can borrow and how much you should borrow. And just make a note here, or a mental note. This is where you start talking about return on equity, because, well, without confusing you, just trust me on this. When you own a rental property that has a mortgage that you're paying down year after year, there comes a point, well, what happens is your return on equity actually goes down every year. As your equity increases, the return goes down. Now, that's connected also to any rent increases that you have, but there comes a point where you should, from a fiscally responsible manner, you should refinance the property. But that's beyond the scope. That's as far as I can take that conversation tonight. Just make a note that that's a topic that you need to explore when you really want to get into rental properties, okay? You need to know what the fair market rents are in the area because that's what you're going to be charging for the house. You know, I'll tell you all this. I have an idea for a new book. I'm going to call it Roger's 2 Rules for Real Estate Investing. You ready? I don't know. Okay, I'll tell you. Rule number 1, buy the house for less than you can sell it for. Rule number 2, rent the house for more than your monthly payments. That's it. The rest of the book is an explanation of how to actually make that work. Other loans and liens. Other loans and liens on the property, you need to be aware of them if they have a home equity line of credit, for example, or if there are mechanics liens or material liens. This is going to be important if you do a creative deal structure. If you buy the house outright, then they have to satisfy all those other loans and liens. So it will not matter as much. Know your rent-ready repairs. The rent-ready repairs are not necessarily everything you would need in order to flip the house. I don't want to get into all that either, but you generally are going to spend less on rent-ready repairs than you would for a flip. Then taxes and insurance, because they still are going to have to be paid. All right. Here are the data points that you need to be aware of and know how to calculate and understand how to use them when you are considering a rental property. Capitalization rate. Now, cap rate is a big thing when it comes to apartments, but it can be useful in the proper context on a single family rental, because you need to know the capitalization rate is the rate of return based on the capital invested in the property without regard to debt or how the capital is structured, either debt or equity instruments. So in other words, what's your return divided by the amount of capital that's in there? And a capitalization rate of say 8%. What's a good capitalization rate? A good cap rate is anything that is better than the loan constant, whether it's your loan constant or if you do a creative deal structure or if you take over a loan subject to their loan constant. So if you know what the loan constant is, which is the true cost of the money. Oh, and look, that's the next thing on here. The loan constant is the true cost of the money. And I'm not going to go into it now, but there's a simple formula for calculating. In fact, if you want to look it up on the internet is your friend. You can figure out how to figure out the loan constant. But here's what you do with this. Well, I'll tell you in a minute. You're going to use capitalization rate and loan constant to end up with a yield spread. Then debt service coverage ratio. This is a number that describes the ability of the income, the net income, to pay the debt servicing. All right? So once you know what your net income is on a property, and net after expenses, you divide that by your costs of the money, your principal and interest. You will have considered taxes and insurance as part of the calculation for your net operating income. You don't need to double count those, all right? But that is a number that needs to be 1.2 or better. I'll show you that in just a second. And then your cash on cash return. This is just simply if you put $100,000 into this property, $100,000 cash, and you end up making $9,000 after all your expenses are reckoned at the end of the year. That's $9,000 over $100,000. That's your cash on cash return. It's 9%. And that is what's going to happen in your average 1%er on a single family home. That's because you have about a 30% in expense ratio taken out of that. Apartments have a higher expense ratio, but again, I can't go into all of that on this call tonight. Okay, so here's how you put it together. First of all, you want a positive yield spread. You take your capitalization rate on this property and subtract the loan constant, and if that's positive, it's okay. It only has to be a little bit positive. And then you take your debt service coverage ratio and hope that it's greater than 1.2. Because if it's greater than 1.2, then that's a property that is most likely going to cash flow, unless it's vacant, it's going to cash flow and it will work. All right. If it's less than 1.2, it may still look like it's going to cash flow on paper, but that's because you're just taking, my payment is $640 and my tenant's paying me $840, so I'm making $200 a month. No, you're not. There are a lot of other things that have to be calculated. In fact, on a deal like that, you're probably going to end up losing money when it's all said and done because of the other costs associated with owning that property. And even that's not necessarily a horrible thing because you have all kinds of nice tax advantages that come from it, and you're building equity at someone else's expense. So there are a lot of things to consider here, but these are the things that describe a winning rental property. Your cash on cash return is greater than whatever you decide the target is. If you can put money into something with similar tax advantages and make 6% versus something with similar tax advantages and make 9%, you're going to go for the 9%, right? Okay. Well, if you've got some like tax-free municipal bond over here, and I have actually owned tax-free municipal bonds that paid 15%. I don't know if that will ever come back again in my lifetime, but if you had a tax-free municipal bond that was paying 3%, and then you had this rental property. See, I'm talking here about comparing everything with everything. You use the other things that are available to you to set your desired targets. Then you see if what you're bringing in from your rental property beats the target. You decide what the target is. It's your life. Okay? Hopefully you've got a mentor or financial advisor that's helping you sort this stuff out. But once you know how to run these numbers, you can compare with your life situation and your goals and vision, and you can make good decisions. That's the reason for all of this. Okay. And the rest of this talk is also, it's just designed for a generic audience, and it kind of introduces the Flipping America RIA. I'm not going to go through all of that because of the time, but I will skip to the end right here. It's question time. So I haven't looked at the Q&A tab yet, but I'm going to open it up now, and there are no questions in here. So if you have a question, put them in the Q&A tab, and I will look back in the chat here. DSCR is debt service coverage ratio. You take the net income from the property and divide that by what it costs to make the monthly payment on the property. And that will tell you, that will give you a ratio, a percentage, and you want it to be greater than 1, preferably 1.2 or better. Can I speak more about the yield difference between the cap rate and the loan constant? Yes, I could, but if you just right now, I will introduce you guys to the Rent Starter course later on where we really dig into this, because I need some time to really talk about the loan constant. The loan constant is not the interest rate, the loan, unless it's an interest-only loan. The loan constant is the true cost of the money, and usually it's a little higher than the interest rate. So if you have a 7% loan for 30 years, your loan constant's usually probably going to come in around 7.5 or 6, something like that. And that's the true cost of the money. If you have a 7% interest rate on a 15-year loan, that loan constant will be up around 9. And in the Rent Starter course, I go through all of this and explain why that is and why that's the true cost of the money. But I can't do it now. It's a little bit too involved. Your property will have a capitalization rate based on the actual numbers that are there. And so if you can subtract the capitalization rate, subtract the loan constant from the capitalization rate and end up with anything positive, that's a good sign. Okay, that's about as far as I can go. MUM is monthly utilities and maintenance. Yeah. All right. Yeah. All right. Okay. I think we got through those monthly utilities and maintenance. And yeah. So that was a long one. I appreciate you hanging in there. I appreciate you being here. And I've got a whole course that goes a little deeper into these numbers, and it's called REI by the Numbers. And we'll have it out in, I don't know, a week or two. And we're going to, you're welcome. And we're going to give away, we haven't even fully decided on the price yet for this course. Hey, here's a good market survey. I don't know if I should do this. If you had a course that fully explained each one of these points and dug deep, so you could walk away with a complete understanding of these words and the numbers and what they meant and the impact that it could have on your life, what would that course be worth to you? Tell me what you think we should sell the course for. And I'm not going to necessarily commit to whatever you guys say, but I'm interested to know what you think a course like that would be worth. And we're going to give away a copy to somebody right now. Let me see if I can bring Chip on. Yeah. Chip, you there?
Hey, Roger.
I haven't seen any numbers. I haven't been paying attention. What number did you pick, sir?
I had 22, and Lana told me what the numbers were before I joined, and the winner is Jay. I don't know Jay's last name. Okay.
Marigny.
Marigny,
Yeah, Jay, you keep on winning, man.
And so did you have any people that guessed in the trial panelists or on Facebook?
No guesses.
Okay, good. So Jay's the winner.
All right, Jay. Congratulations. We'll be in touch. Lana's made a note, and we'll be in touch when we get the course done. All right. So, wow. All right. We've been through a lot of stuff tonight, a lot of numbers. Thank you for your patience. Thank you for being here again. It is an honor for me to sit with you on these Wednesdays and Thursdays, introduce you to some really cool people around the country, and occasionally talk to you myself. So thanks again for joining us, and we will see you very soon.